In a piece that you wrote this morning, you write that Bernanke is the worst boyfriend for the markets.
Well, I'm here to stage an intervention, which is
really?
I want to talk to analysts.
Counseling.
Counseling, and it's just like, no, just sit down like a best friend and say, Ben Bernanke is just not that into you. He's been very clear that that he's going to make a decision, that the committee's going to make a decision when they get together at their meetings, and they're going to look at the prevailing economic conditions, and they're going to make a call. But then what happens is he'll testify in front of Congress, and he'll say maybe within the next couple of meetings, even though we're still going to make a decision, and then the markets will freak out, and they'll say, that's a clear signal. He's communicating with us, and it really
Wait, so you're saying like women read too much into words? Is that what you're saying?
Both genders read too much into
Wow.
words. I'm just saying that the markets are acting like a spurned lover, waiting for a text, when in fact he's been very clear. I don't know what I want out of this relationship. I'm going to make a decision.
Help me out here.
But
He's exactly right, and the problem is that the markets got used to Alan Greenspan constantly whispering into their ear, "I love you, baby," and and then they expect.
And who can't picture Alan Greenspan doing that?
Exactly.
I think there's a historical problem here, which is that central banks all over the world have gotten used to the idea of forward guidance, sort of dropping hints. So markets have even through Greenspan, got slightly more clear, slightly less muddled over the course of his tenure. So markets have come to expect. They've come to sort of do a little bit of Kremlinology, to use a different metaphor.
Okay, let me just play devil's advocate for a moment, because what if Ben Bernanke has said, look, I have been clear at these news conferences. I have said exactly what I mean, what I'm going to do, but then the markets overreact, maybe women overreacting, and then they have to come out and actually try to explain the situation,
markets are
and that gets them in trouble.
Is that what you're saying?
I just think that every time you look at these things that are supposedly hints that markets are reacting to, they're couched in so much language, I don't really know, maybe, and that to me is exactly like a relationship.
See, I think that Ben Bernanke,
run away from
Ben Bernanke has made $4 trillion worth of purchases at Tiffany's for the markets. He's been as good a boyfriend as you possibly
That's a big diamond ring.
By flooding those little blue boxes into the markets with great affection and love, as we've been discussing all morning.
But
for
one of
the
the
markets.
problems is that back in June he said, by the end of the year, if the economy continues, we could be tapering, which was a fairly specific statement, particularly when he coupled it with, when we're done, the unemployment rate will be at 7%. The problem is the markets took that as, we're going out to dinner Saturday night. And when he didn't take them out to dinner, they were very disappointed.
I think women are getting a bad name here. Okay,
I think we've beat this metaphor like a dead meat.
I think we're done.
Okay, so let's talk about Janet Yellen, though. Okay, no, go ahead.
Well, I think there's another problem, which is that habits last a long time. The people trading now have been developing these habits over a decade. What's different now, among all the other things that are different, is that the Fed also has to make fiscal policy. The Fed is sort of the only body capable of making any policies. So it has to watch unemployment even more closely than it did before. It has to pay attention to that other half of its dual mandate, because Congress is not going to fix it. The rest of Washington can't do anything.
Well, so for now.
For now. Do you see a path out?
I don't see a path out, but it wasn't always like this, though, Brendan.
It wasn't always like this.
Right.
But it was this bad in the Gilded Age, and it took a long time for things to get better. But I think that's part of the problem, is the Fed is looking at more things, is more concerned about unemployment than it used to be, because it is the only game in town that's doing anything about unemployment.
Good. One small problem that they have that didn't occur before is that they succeeded. Ben Bernanke wanted people to take more risks, and they have taken a lot of risks. A lot of investors are out over their skis. When they think that policy is going to change, or when they see a hint that that policy is going to change, they want to pull back. They don't want to do it till the last minute, because they keep wanting those returns, but they need to move quickly, which is why you see these exaggerated moves.
On a serious note, though, how much do you think Bernanke is very concerned about his legacy? What his legacy will be?
I think he's smart enough to know that he can't control his legacy now. It is what it is, and it's in large measure going to be dependent on Janet Yellen and how they get out of this extraordinary policy. If they manage that, then people will look back and say, well, maybe he did as good as anybody could have done.
But to that point, I mean, you see the result of those policies. You've got companies like Tiffany's crushing numbers, and you've got Costco cutting numbers, and in the places where the benefits accrued
it's
are not
counterfactual.
equal.
You don't know what would have happened had they not done these things, and this was a tremendously unusual situation.